July was one of the best months since 2020. What does that mean for the month of August? That's coming up on 3 Minutes on Markets and Money. We've been talking about now for the last couple of months, really, that the markets were extremely bearish, very oversold, and due for a very nice counter-trend rally. That happened in the month of July. Finally got that rally we were looking for. Now, this was after the market had spent the month of May and June declining, and then in June really kind of started forming this base in the markets where markets stopped going down. They just really weren't going anywhere at all. Then, of course, as we got into July, finally started getting a bit of lift here, triggered a MACD buy signal in late June. That translated into higher prices last week on this idea that earnings weren't as bad as expected. Markets really got a tailwind underneath them with technology really kind of leading the charge here. When the market started to kind of sniff out that deflation may very well be a bigger issue than inflation going forward, we'd see this rotation from value back into tech. We saw that very much so last week here with the market retesting the 50-day moving average after the break above it, and then this very sharp acceleration, which is kind of the exact bullish setup that you want to suggest higher stock prices in the near term. Now, as we move into the month of August tends to be a little bit weaker month, and after a very, very big gain in July, would not be surprised to see a little bit of a pullback, kind of a consolidation in the markets for the month of August. That wouldn't be surprising at all. Of course, a lot of this is going to depend on the Fed and what is happening with inflation. As we get into the July report that we'll see in August for CPI, if that number is still accelerating higher, that could start to push Federal Reserve expectations for a stronger rate hike in September. One of the things that was also helping kind of fuel this rally was this news from the Federal Reserve last week. They said, well, we're going to start looking at inflation on a meeting-by-meeting basis and judge our rate hikes from there. The market took this as, oh, the Fed's about to pivot, and that means they won't raise rates as much. That really brought Jim Cramer out of the fold to say, hey, this is your time to buy stocks when the Fed pivots. That's not actually the case. If you take a look at Fed funds rate, when the Fed stops their rate hikes, typically that precedes the onset of a recession and a decline in asset prices. So I'd be careful jumping in on the fact that a Fed pivot is actually good for stocks. Historically, it really hasn't been. But as we move into August and September, in particular, because the next meeting for the Fed is in September, pay attention to what's happening with inflation, because that's going to lean on the Fed to be more aggressive about rate hikes. But more importantly, at some point, we've got to see the market catch up with the reality that earnings not as bad as expected doesn't mean those are good earnings. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. See you back here tomorrow.